To you today to touch on a couple different factors with your credit report and your scores. You may have seen this information on the internet or heard about it from somebody that you might know. I'm going to go over these 5 key factors in your credit scores that not only should you know about, but also understand how they need to be addressed. Number 1, the biggest portion of your credit rating is based upon your payment history. And your payment history is on-time payments, late payments, collections, judgments, tax liens, anything derogatory, and then also obviously your positive payment history helps you for the better. We actually have processes that effectively go through a dispute to the negative items that are reporting on your credit report, like collections, tax liens, judgments, bankruptcy information. Anything derogatory has the ability to come off your credit. The Fair Credit Reporting Act was written in 1970, and it was also backed up by the FACTA Act, the Fair and Accurate Credit Transactions Act, in 2003. And this basically gives you the rights to not only dispute your accounts, but also see what's on your credit report. Before, as little as 7 years ago, you actually didn't really see what was on your credit report. So you'll see online monitoring services, they have a lot of commercials these days. True Credit's a great monitoring service. MyFICO.com, Credit Check Total, all these are pretty good, but we typically like our clients to sign up for True Credit, which is offered by TransUnion. They'll give you all 3 credit scores, all 3 reports. You can update all 3 every 30 days. It's only $14.95 a month, and it's a very effective tool. Secondly, your debt ratios on your open revolving accounts. These are your credit cards. If you have your credit cards maxed out, your FICO score is going to be lower. If you have available credit on those accounts where you don't have them maxed out, you're going to have a higher credit score. And that's the basic principle of your debt ratios. If you have the ability to pay down your revolving credit cards to at least 50% of the credit limit, but we really like to see you down to 30% of the credit limit. Say if you have a $1,000 credit card, try and keep it at $300 if possible. Once you pay it down, we have a process of rapid rescoring, whereas your new balance will show on your credit report in about a week. If you just let it mature on its own, it's actually going to take 60 to 90 days for that new balance to report to your credit report. The credit card companies are very quick to report the bad. If you go late payment on a credit card, it hits your report immediately. If you pay down your balances, it's actually going to take a couple months for them to actually give that data to the bureaus. So they're doing everything that they can to keep your scores as low as possible as long as they can. Also, inquiries into your credit. Anytime that you have your credit run by a mortgage company or auto finance, if you're applying for a job, sometimes they'll pull your credit, or you're looking to rent somewhere, they're going to want a credit report as well. All these inquiries are what they call hard inquiries, which are commercial inquiries that do negatively impact your scores. A lot of people have a misconception that their scores might be affected by only 3 to 5 points, but we have actually seen inquiries affect your scores by up to 10 or 15 points, depending on some of the other information on your credit report. So there is no rule of thumb as far as how bad an inquiry helps or hurts your scores, excuse me. We have a process of disputing those to get those inquiries off of a credit report. Diversity in your credit affects your scores by 10%. If all you have are a couple credit cards, you're actually going to have a weaker report and score than it would be if somebody had revolving accounts, installment accounts, and also even a mortgage. They're going to have a much higher credit rating than just somebody with a couple credit cards. So it's a key element in this is to have diversity, have different types of accounts that you're managing properly. You'll have really good credit. And last but not least are the length of your credit profile. If all you have are new baby accounts that you've only had for 6 months or a year, these are new accounts that need payment history. They need to mature. The last thing that you want to do is cut up your credit cards that you've had for 5, 10, 15 years. That's credit suicide. Don't let anybody tell you that that's what you should be doing. Because your credit is king, and you can't reestablish that trade line that you've had for years and years. It's going to take you that much more time to establish new accounts if you cut up your credit cards. Make small charges every couple months on those credit cards to keep them active. If they're not active, they're not going to report to your FICO score, and then they'll actually go to an inactive status on your credit report. When it hits an inactive status, it's not helping your FICO score, so you need to keep those accounts active. And if you do have any collections or negative items, particularly collections, a lot of people do not request a deletion letter when they make payment on a collection account. This is key critical information that you need to make sure that you request at time of payment. Not all collection companies will give you that deletion letter, but they're not going to pony it up if you're not asking them. So call NCO Financial or whichever collection company has your account. Say, I'm going to make payment with you guys today. For payment, I would like a deletion letter. Prior to you making payment to them, have them email or fax you over something in writing, and they will furnish that to you. Once you have the deletion letter, get that to us. We'll